How hedge funds exploit the market. Let me break it down for you. These hedge fund players got 5 different strategies in their playbook, and the most popular one is equity long short. Equity is just another word for stocks. So, these hedge funds take both long and short positions, which they can potentially make big bucks no matter which way the market goes. One of the most powerful moves they make is called pair trading. You gotta focus on 2 similar stocks, like Microsoft and Snapchat. If you think Microsoft is a steal and Snapchat is overhyped, you can go long on Microsoft and short on Snapchat with 10 band of each side. If both Microsoft and Snapchat tanks in the same time, you will lose no money and will only win big stacks when Microsoft outperforms Snapchat. So if you want to be a baller like these hedge fund players, you gotta know how to pair trade. Another dope strategy is called event-driven investing. Basically, they invest in companies that are going through some big corporate events like mergers, bankruptcies, or spin-offs. It's all about finding the catalyst by knowing what events are going to impact the company's stock price. So, if you want to be a player in this game, you gotta know how to work the events and find that catalyst, because they are investing some serious cash. This let them directly meet the big guys of the company like CEOs and managers to get the inside information on the company's plans. Insider trading, 8. Another fly strategy is called activist investing. Some hedge funds invest in companies and then get all up in their business. They might act as a consultant or even become board members. By working closely with the company's management team, they can find ways to make the company more efficient and grow their profits. And here's a little tip for y'all: these hedge funds gotta report their US stock holdings every quarter in a document called 13F. But you ain't gotta go digging through all that paperwork. Just check out Whale Wisdom, where you can see all their top holdings and moves of the hedge fund from the past quarter. Another dope strategy is called financial modeling. They use stuff like DCF, discounted cash flow model, and FCF, free cash flow model, to find stocks that are undervalued and stocks that are overhyped and ready to be short sold. Frankly speaking, all students who did finance in their university have already heard of this. So let's carry on. But let's face it, we ain't got no time to be learning how to build a financial model. That's why I'm gonna put you onto something called target price. Just search for your stock in Bing, and you'll find a 1-year price target from investment banks. And let me tell you, these targets are pretty close to what these hedge fund players are calculating. 8. It's time to learn about gross exposure and net exposure. Gross exposure is all about the total value of your long and short positions, while net exposure is the difference between the value of the long and short positions. For example, let's say you got $100 in the bank and you use 50 to long Microsoft and 50 to short Snapchat. That means your net exposure is 0%. But if you use 50 to long and only 40 to short, then your net exposure is 10%. Now, when it comes to gross exposure, these players can use leverage to get even more banger from their bucks. Like if they use $100 to long Microsoft and 80 to short Snapchat, then their gross exposure is 180%. Some of these players hit that thumbs up button and use a market neutral strategy, where they keep their net exposure around 0%. That means they gotta be extra good at picking stocks, you dig. Check out Marshall Wace. They manage over $2.5 billion and keep their net exposure around 0 to 10%. And they are making some serious bangs, with an average return of around 15% per year. These hedge fund players often specialize in specific sectors. Some of them focus on the energy sector, like upstream, downstream, and oil services companies. And others get into specific industries, like banking or biotech. But here's the kicker: some of these players go after mid or small cap stocks, instead of rolling with the big boys. Mid-cap stocks are from companies with a market cap between 2 and 10 billion, while small-cap stocks are from companies with a market cap below 2 billion. Why do they do this, you ask? Well, these smaller companies might not be as well-known or followed by Wall Street, so there's a chance for these hedge fund players to spot undervalued or overvalued stocks that the market has overlooked. They're always on the lookout for that next big come-up, you dig. That's a wrap for today. Don't forget to hit that like and subscribe button and drop a comment down below. Happy trading, and keep hustling like a boss.